Hi, everyone. Paige Panzarello, the cash flow chick. And I want to talk to you about time. Time, as we all know, can either make or break our profit. So it's really important when you're doing your due diligence, no matter what type of investing you're going to be doing, whether it's in real estate or other alternatives, or notes. As you know, notes is my preferred method of investing. I focus on it completely. And I just wanted to bring to your attention, though, that when you're deciding whether or not to invest in a note or notes or any other type of investment, any other real estate or any other alternative, like I said, a lot of people don't factor in the time element. And what I have learned throughout my career is that we might have a project or a note that has a great return on investment, right? A great ROI. However, if you miss in terms of figuring out how much time your invested dollars are going to be in that particular investment, that could diminish or make your profit, right? So when I'm teaching my students in my workshops, I teach people that you need to figure out what you want in terms of your invested dollars and how much time you want to be invested. So if you're a short-term player, right, you're going to be looking at certain investments or certain states. In the case of notes, you're going to look at certain states that do not have a long time period in terms of our worst case scenario for an exit strategy, which is foreclosure, right? So if you're the short-term player, you don't want to be involved in an asset that you're going to be locked up and your money's going to be locked up and your profit's going to be locked up for 4 to 5 years, right? You're more like 18 months or less. So you're going to have to figure out that time element. The other thing that you're going to have to figure out in relation to the time element is the cost related to the duration of time. And a lot of investors don't figure that out. And so they go into this deal thinking, oh, this is going to be a great deal and I've got a projected great return on investment, meaning I'm going to make a great profit, but they don't figure out that it's going to take 3 to 5 years to get that great profit, in which case your costs may exponentially go up. In terms of note investing, we have what we call workout costs, meaning there are certain costs that are associated with the time duration in order to be able to bring that note to a successful conclusion. Okay, so if you're figuring out if you're only figuring costs for 6 months and your investment takes 18 months, you potentially are probably eating into your profit. So time is a big factor when you're analyzing any kind of deal. It doesn't matter whether it's stocks, whether it's real estate, whether it's whatever it is. Alternatives, if you're an angel investor and investing in startups, right? That time factor is a key component that is often missed, especially by new investors. So make sure that you don't let time kill your profit. Figure that in to no matter what you're investing in. Anyway, I hope that you find that helpful. As you know, I mentioned that I do teach my students. If you're interested in learning about that, we have an on-demand Building Wealth with Notes course. You can find that at buildingwealthwithnotes.com. You can go to cashflowchick.com and learn about that as well. And I wish you every success. See you next time.